let's bring up this jobs data then. So the delayed report came out yesterday. In a nutshell, not very good at all. I've put a link to the Zero Hedge article here, but I'll just read through the main numbers. So BLS data showed just 41,000 net jobs added over the past 4 months. That's quite low. The unemployment rate hit 4.6% in November versus a 3.9% average since 2022. And at real rates suggests 5 more Fed rate cuts are possible. There's a bunch of revisions in there, and I know that some people listening to this will, not agree with BLS data for a variety of reasons. I understand that. There's been a lot of, shall we say, fudging of the numbers, I can imagine, or massaging is a better word. There's probably been a lot of massaging over the time. But again, what these numbers show is that beneath the surface, the US economy doesn't seem to be strong. It seems to be weak. It seems to be getting weaker as well. Now, the reason I mention that is that, as mentioned last week in the commodity wrap, the market wrap, and on the midweek macro, what we have to do is take a step back. And yes, there could be a complete and utter catastrophic market collapse in 2026. There might not be. Who knows? We'll get onto the S&P 500 a bit later on. But the point being that with this jobs data and the potential new Fed chair, which is meant to be announced at some point in December, and that could lead to a more dovish Fed. Now, if we have a more dovish Fed, what does that mean? That means that those interest rates are very likely to drop even further. Not the correct move, in my opinion, but I'm not a Fed chair. The point being on that is that if the rates continue to decrease, then what does that do to the markets? What does that do to gold? What does that do to silver? Well, it's likely going to push them in the opposite direction. So if we take a layman's terms of view of these things, then that helps us to create our market thesis for 2026 and beyond. Yeah, let's see what happens. But again, very interestingly, that data there and the markets haven't reacted very well to that at all. Talking to markets not reacting, let's have a quick look at the numbers. And again, I should point out, it's just coming up to 5:30 Eastern on Wednesday, the 17th of December. So we've got the S&P 500 is down 106 points on the week, currently at 6,721. We have the NASDAQ also down on the week. It is currently at 24,647. And we have the Dow Jones also down on the week. That is at 47,885. The Dixie, the dollar index, that is ever so slightly down on the week. It's down 0.016. It's currently at 98.377. And the VIX index, the thing that measures the volatility in the S&P 500 itself, that is it's 11.94% up on the week. It is at 17.62. Ultimately, that is saying that, ultimately that's saying that we've got regular market volatility. So nothing out of the normal, to be honest. Now, what's going to happen moving forwards to the stock markets? Well, again, I'll go back to the layman's terms that I've just explained. If you think interest rates are going to continue to go down, that's likely going to fuel the markets much higher. I was speaking to Paul Kiker of Kiker Wealth Management. You might know of him because he does a weekly chat with Dr. Chris Martinson over at Peak Prosperity. Two things on that. Number one, I'm delighted to announce that Paul Kiker is going to be appearing on the Contrarian Capitalist podcast towards the end of January. So I'm really looking forward to that conversation. And we briefly went through a couple of charts earlier on. And what he was saying, and I'm going to paraphrase this, is that the market's on tenterhooks at the moment. Because if it makes a substantial break to the downside, then he believed that you could be looking at the April lows that could be in contention, which for the S&P is about 4,800. Now he's not saying that is the case and that is going to happen, but he's saying that he needs to see very clear market breakdowns in order for that to become a potential target, a severe target at that. He said if not, then you could be looking at a 15% retracement from where we are. And he highlighted the 6,100 number on our call earlier on. So hopefully you won't mind me sharing that information. It's not exactly a secret. It's things that he's discussed on Peak Prosperity as well. So in effect, watch this space. Now, if we go ahead and have a look at the commodities, so we've got gold is at 4,337 at the time of recording. Silver at 66.20. Silver did hit $67 actually earlier on in the day, depending on what chart you look at, but it hit $67. Platinum is soaring. That's up 9% on the week, currently at $1,895. And we will look at palladium. Palladium also soaring on the week. It's up 10.5%. It's currently sitting at $1,646. Now, of course, there's records being broken, all the time here. I think the thesis for gold, silver, platinum, and palladium, I think they're well lined out. Gold is doing what gold is doing because of a variety of factors that we've discussed ad nauseum on the show before. Silver, again, we've discussed ad nauseum. It's not just demand factors. There's a lot of supply factors at play as well. That goes for gold as well. And of course, with platinum and palladium, again, EVs and catalytic converters, and the fact that a lot of it between platinum and palladium comes from South Africa and Russia, respectively. Of course, South Africa's got its own internal challenges with energy policy and inflation, and of course, I think the embargoes and trade challenges against Russia are well documented and have been so for the last few years. There's also a very high risk concentration in platinum and palladium as well. You should also remember that gold and silver are turning, if not they have turned into gifting goods. I'll put a link to what a gifting good is just in case you're not au fait with it. But in a nutshell, it's higher prices and higher demand. It's a vicious cycle upwards, which of course, if you've taken a position in silver or you are continuing to stack, then hats off to you. Of course, I don't do financial recommendations on the Contrarian Capitalist, but I always say that if you're going to dollar cost average in, then that's probably a very smart thing to do. If you're looking to try and trade these markets, again, I would act with caution, because if you look at the RSIs, whether it's on weekly or monthly, silver especially is very overbought. But again, I'll relate back to a gifting good, because if higher prices and higher demand feeds into the cycle, then the RSI could be whatever, because it's going to continue to go up. I'm not saying that's the case with silver, but we're certainly going to have a very interesting 2026, to say the least. I should point out as well, and I should really do this at the start of videos, that if you're yet to become a free subscriber to the Contrarian Capitalist, then please do so. contrariancapitalist.substack.com. Also, you can become a paid subscriber. Please allow me to serve you at a higher level. The channel itself is designed to help you to protect your wealth, defend your freedom, and outsmart the system. Prices on the annual plan start, they work out about $9.20 a month. If you go monthly, it's $11 US a month, and you can take advantage of the founding member plan, which is a one-off lifetime investment. I think that's about $355 if I'm not mistaken. And again, you pay once and you're a Contrarian Capitalist for life. I plan on running the channel for a very, very long time, so I'm pretty sure that it's good to see more and more people taking up the founding member option. And of course, if you listen to this and you run a business, speak to your accountant, of course, but I would imagine because of the content on the channel, it would be classed as a business expense or tax deductible expense. Again, speak with your accountant on that, because I know there's a lot of business people and company people that listen to the Contrarian Capitalist. Now, if we go back to oil is very, very interesting. There's 4 podcasts and posts that I would highlight that you go and listen to. Number one is the podcast video with Trader Ferg last week. I would also recommend you go and listen to the podcast with Adam Rosenswag as well. The other 2 I've mentioned earlier on, that's Giacomo Prandelli and the written post by the excellent Tom Bradshaw. Go and listen to them, go and read them as well, because there's a lot of confusion within the oil industry at the moment. Now, my position on oil, and I've been clear about this in the commodity wrap, is that I'm looking to go long. Now, I've not gone long yet, but it is something I'm looking to do, and here's why. There are a lot of supply and demand issues within oil. The narrative that we are being fed isn't necessarily true. So the IEA, I think it's the EIA, I think it's the IEA, apologies. There's all these, missing barrels and so forth. You see these news headlines such as, Trump, blockading Venezuela and stuff like that. I went through again, Giacomo Prandelli went through this, and there's a really good map on there. I'd highly recommend you have a look at a map of North America and South America. Look at the shipping channel between the Mississippi Basin and Colombia, Venezuela, and Guyana. Interestingly, I think what the USA is trying to do, rightly or wrongly, how they go about it's up to them, but they realize that they need to become more resource independent, or certainly look at their neighbors and look at what to do in that situation. The common consensus is that what you're seeing in the news, and we saw this in the bounce in WTI and Brent today because of that, blockade and other factors at play with Trump and the current administration. Oil is in, for the short term, very likely in a structural bear market. It is possible that it's going to go down to $40 to $50. I'm talking WTI here. It's very possible that it's going to go down. So if you look at the bounce today, you might decide you want to go long. I'm not taking that position yet because I think it's a news event. December, January, February are historically not that good for oil in general. So we have to bear that in mind. Secondly, we keep getting fed this narrative of oil glut, oil glut, oil glut. Now, that might be true, but it also might not be true because there's a lot of issues behind the scenes. With oil and the current oil fields, whether it's Russia, whether it's Saudi Arabia, it's not as easy as just switching the tap on and voila, we have an extra, 1 million barrels a day, off we go. So it's not as simple as that. Also, a lot of people out there believe that demand is very understated. So again, it's similar to other commodities that we discuss on the Contrarian Capitalist, where we have supply issues, we have demand issues. They're not necessarily being represented properly, and therefore, although the narrative is oil glut, oil glut, oil glut, we've got a big issue here. Well, there's been the lack of investment in oil facilities around the world as well. So when oil becomes more hated, and I still think it can be a bit more hated within the next couple of months, that's when, as contrarians, we've got to go looking. And that's why I'm looking to take a long position. Even Eric Townsend of Macro Voices, who's been on the Contrarian Capitalist podcast before, his podcast episode last week with Jim Bianco, he mentioned that he's looking to go long, but he's not gone long yet because of seasonality. So this is why, even though we had a very good day today in WTI, if you look at a longer chart as such, then there's still room to go to the downside. Of course, we need to tie this back in with jobs data, which is where we started, because if jobs data is showing that the economy is weaker and that there are recession fears or contraction fears, certainly, then what does that normally do to oil? Well, that normally puts price pressure on oil. Rightly or wrongly, that's what normally happens. So if the S&P does start to break down, and again, it's not had a good week so far, but if it continues to break down and bad news continues to flow, that's likely going to have an impact on oil, which is likely going to send prices downwards. So it's going to put price pressure to the downside. Now, this is short to medium term I'm talking about. This is why 2026 is going to be a very interesting year. Because on the flip side, well, what if there is not a recession? And what if data gets better? Well, of course, that's absolutely plausible. There might not be a recession. The data might get better. Well, if that's the case, then it'll be interesting to see what the supply and demand figures are from the IEA. And do we see that narrative starting to shift? So again, it's really a case of watch this space. I have no, advice or any of that for you. All I can tell you is what I'm looking at, and I'm looking to go long, but I'm not there quite yet. I'm certainly not jumping in today because I think that although there might be a further bounce to the upside, again, we're just looking at general, geopolitical news. And you might be saying to yourself, well, Rob, but what if Russia and Ukraine sort out their mess as such? Well, I don't think that's going to happen, but let's just say it did, and the sanctions on Russia were stopped. Again, this is highly unlikely, but never say never. Well, then the oil market might get back to normal. And of course, if we then see Russian crude and so forth hitting the EU markets, then that could put pressure on prices to the downside. But at the same time, because of Russia's biggest trading partners at the moment in oil being China and India, if you're taking that supply away from them and the Chinese and Indians want oil, that could actually push the prices up. So no matter what way you look at it, there's not a definitive position or direction that oil could go. But my opinion, and I'll share this with you, is that I think short to medium term, so next 4, 5, 6 months, I think there's going to be more downside in oil. But if we look at the long-term point of view, and again, Giacomo Prandelli said this, Tom Bradshaw has said this as well, Adam Rosenzweig has said the same, that if you look at the long-term view, 5, 10 years, because of the lack of investment in oil around the world, and because the point being that there's likely challenges with the supply being reported and also the demand being reported, i.e., supply is tighter than people are making out and demand is stronger than people are making out. Again, all you've got to do is put those two factors together, and that's very likely, it's not a certainty. Of course, we need to combine that with the weakening of the US dollar as well. So add that factor in. That is very likely going to lead to a much higher oil price moving forwards. And of course, then we start bringing in lower interest rates. We start looking at inflation. We start looking at potentially hyperinflation as well. And again, all you have to do is look at a chart from the 1970s, and you'll know that culminated in much higher commodity prices towards the very back end of 1979. And of course, the start of 1980. Now, history, of course, rhymes. Whatever the Mark Twain quote is, I think it's Mark Twain anyway. I'm waffling on. Point being, that oil has got a lot higher to go as part of an overall commodity super cycle. So watch yourselves if you're looking at the oil market. Again, don't get too excited by daily movements. I still think there's a bit more downside in the short term, but certainly from a futures point of view, 5 or 10 years, there's going to be a lot of upside, a lot of potential there, and of course, a lot of profit potentially to be made as well. In short, watch this space in oil. Further on below, after the various podcast and post links, there's a couple of generic news links from the week. So again, one is linking to the Bank of Japan, and they're expected to hike rates to a 30-year high. That might be sooner rather than later because of the time difference. So I think that announcement is imminent. The Bank of England tomorrow, again, they are looking to potentially lower rates as well. And the reason for that is that inflation has slowed. Good luck with energy policies and whatnot over there. So again, I think interest rates need to go higher. I'm in the Peter Schiff camp, but of course, I think they're going to go lower. They shouldn't, but I think that's what's going to happen. So I'd expect to see Bank of Japan lower rates. I'd expect to see Bank of England lower rates as well. I also got an article from the BBC saying that Trump is good news for NATO. On the other hand, there's a Putin point of view on that. You make of that what you will, to be honest with you. Again, there's an article there linking back to the jobs data, and then there is an article actually relating back to WTI and how that is held after the Venezuela blockade. That's a word I couldn't think of earlier, the blockade. So just be careful of that in oil. Again, I'm just sharing what I think. I could be completely wrong. It could just sail to the upside from here. But I'm also thinking seasonality is going to play a part moving forwards. As mentioned a little while ago, please do check out, of course, our sponsors for this midweek macro poly market. Do check out the midweek poly market above. And as always, please do subscribe to the Contrarian Capitalist if you haven't done so. Please become a free subscriber. Allow me to serve you at a high level by becoming a paid subscriber. And of course, you can take the advantage of being a founding member, which is a one-off investment. And that is a one-off payment. And you are a Contrarian Capitalist for life. There's a lot of excitement going on in the commodity space. This channel is going to run for many years ahead. So I'm sure it'll be well worth the investment as a one-off. And of course, if you are listening to this and you are a a newsletter writer or you're in a business, again, speak to your accountant, because I imagine that any paid membership will likely be a tax deductible expense. But again, double check that out with your accountant. And I should point out, it's the last couple of calls, the 2-hour private strategy calls with the Contrarian Capitalist. They're at a special price of $147, and that's until the 31st of December 2025. All that is that's a focused 2-hour session. You set the agenda, I chime in and give you my thoughts and ideas about what to do moving forwards. We could talk commodities, macro, plan B, residencies, property, precious metals, geopolitics. I am at your whim for 2 hours. Again, that's running at a special price until the 31st of December 2025. The links to all of that, as I've mentioned, are going to be in the post that come with this video. My apologies, it's been a little bit late today, and do watch out for the commodity wrap. That will be with you on Friday as well. And there will be an extra post with you on Saturday that outlines what you can expect post and podcast wise from the Contrarian Capitalist over the Christmas period. Have a fantastic evening. Take care. Thanks in advance for becoming a subscriber and for continuing to help grow the Contrarian Capitalist channel. And see you soon. Take care.